Hello everyone. If you are passionate about understanding the intricacies of economics versus the financial world, you are in the right place. Our channel is dedicated to demystifying the complex universe of stocks, bonds, and economics. Subscribe, join our community, and step into a circle of knowledge designed to support you. Each video is crafted to enhance your understanding and equip you with the tools you need to navigate the financial markets confidently. Subscribe. Thank you for watching and send me your comments. Today we are diving into This Week in Earnings, a crucial snapshot for anyone invested in the financial markets. Whether you are an analyst, an investor, or just keen on understanding the economic forces at play, this video is going to be very helpful. My name is Cam Calderon, and I am thrilled to guide you through the latest earnings insights and what they mean for the market. As we navigate a landscape of fluctuating markets and economic uncertainty, understanding earnings is more than just numbers. It's about grasping the heartbeat of the economy. This week, we've seen a blend of surprising turns and expected outcomes, but what does it all really tell us about the health of the financial world? In the first quarter of 2024, the Standard & Poor's showed a robust earning growth of 7.1% year-over-year. Stripping out the volatile energy sector, that growth accelerates to an impressive 10.2%. These figures aren't just statistics. They are a testament of the U.S. resilience and a dynamic nature of companies amidst challenges. Have you considered what drives these numbers? How do sectors vary in performance and what could mean for your investments? Today we will unpack these questions, looking at which industries are exceeding expectations and which ones are facing hurdles. From tech giants to healthcare innovators, the earning landscape offers a mosaic of performances that reflect broader economic trends. With over 3/4 of companies beating earnings estimates, there's a lot to be optimistic about. But what about the other side of the coin? Stay with us and we delve deeper into the earnings scorecard, explore the high performers and underperformers, and provide actionable insights. This Week in Earnings is your window into this week of World of Finance. Let's get started and unlock the stories behind the numbers. We are diving into the latest installment of This Week in Earnings. Our focus, a comprehensive analysis of aggregate earnings, estimate revisions, and growth rates. My opinions of this video are made possible thanks to the detailed data and insights provided by London Stock Exchange and a leading global financial markets infrastructure and data provider. The report that I am using for this video is actually developed by them. Here is a draft for the next week when we dive into the Q1 2024. The performance of the Standard & Poor's 500 delivered a noteworthy overall earnings growth of 7.1% year-over-year. This figure represents the robust health and upward trajectory of our major industries despite varied economic pressures. More interestingly, when we exclude the energy sector, as we said before, it leads to an impressive 10.2%. So earnings growth leads to an impressive 10.2%. This adjustment gives us a clearer view of the underlying strength of the US economy. As sectors like technology and consumer goods continue to expand their market influence, what is driving this growth? It's a mix of strategic adaptations to consumer demands and technological advancements. Companies are not only surviving, they are thriving by innovating and redefining their operational models. Let's explore which sectors are leading this charge and how they are achieving these remarkable numbers. In quarter 1, 2024, the past quarter, we've seen a steady increase with the Standard & Poor's 500 marking a revenue growth of 3.5% year over year. While this number reflects the ongoing resilience across various sectors, which I believe is remarkable, it's particularly interesting to observe the adjustment when we exclude the energy sector from this analysis. Excluding energy, the revenue growth ticks up slightly to 4.1%. This adjustment is crucial as it provides a clear picture of the broader economic activity. Excluding the often volatile swings associated with energy prices, such insights are essential for investors and analysts who aim to understand the underlying trends that drive market movements beyond the immediate impacts of commodity price fluctuations. That is why we take out the energy sector. By analyzing the data without this sector, we can better understand how sectors like technology, healthcare, and consumer goods are truly performing. And this will give us insights into where the real growth opportunities for us lie. They are not just numbers, they are a reflection of the underlying forces shaping our economy. Let's explore which sectors are leveraging these trends to outperform and how this could influence our investment decisions. Here on this slide, I have a dashboard. This quarter, 76.8% of the 397 reporting companies have beaten earnings estimates. This shows a robust performance against a long-term average of only 66.7%. This indicator of positive momentum is crucial for investors seeking confidence in the market's health. And it's possibly a very good conclusion. Actually, you can see how beating earnings in a regime during an interest rate regime of very restrictive interest rates, I think this marks a remarkable time in the stock exchange. Let's take a closer look at the sectors that stood out. The healthcare sector showed exceptional performance with 91.8%, almost every company, surpassing earnings expectations. Healthcare sector. On the flip side, the utility sectors lagged with only 56.5% beating estimates, which raises questions about the challenges this sector is facing. On the revenue front, 60.9% of companies reported revenue above expectations, slightly underperforming against the average of the past 4 quarters, which is 65.3%. So the revenue for is slightly under the average. This might hint at more conservative revenue forecasting or potential headwinds in market demand. Particularly noteworthy is the information technology sector. 89.1% of companies beat earning estimates, reflecting a strong growth and perhaps benefiting from increased digital transformations, e.g. AI, initiatives across industries. As investors, these numbers give us a layer of insight into where the market strength lies and which sectors may be facing headwinds. The sectors that have truly stood out in the first quarter of 2024 can or are, following the information of the London Stock Exchange report, are communication services and healthcare. These sectors have not just performed, they've excelled, showcasing the dynamic nature of our economy even in challenging times. Well, I say our economy, but the US economy. Starting with communication services, which saw an astonishing earnings growth of 43.5%, this phenomenal increase is not just a number. It reflects the surge in digital communication demands and media consumption that continue to shape our daily lives. Particularly noteworthy to write down in our trading ideas are industries like movies and entertainment, which soared by an incredible 90.5%, and interactive media and services by 75.6%. These figures highlight a sector that is rapidly evolving and adapting to new consumer habits and technological advances. On the other side, we have the healthcare sector, which unfortunately didn't share the same fate, experiencing a decline of 24.3% in earnings growth. This drop is primarily driven by pharmaceuticals and biotechnology sub-industries, which have faced significant challenges this quarter. However, removing these sub-industries from the equation, if we remove them, we have a modest growth rate of only 1%, indicating that specific issues rather than sector-wide downturn impacted these results. These contrasting performances give us a clear view of where the momentum is and where the challenges lie. As we continue to navigate through 2024, the agility of sectors to adapt to economic pressures and consumer trends will dictate their trajectory. It's more crucial than ever to keep a close eye on these developments and understand the underlying factors driving these changes. Let's explore the forward-looking earnings estimates for the Standard & Poor's 500, focusing on the fourth quarter price-to-earnings PE ratio, which currently stands at 20. This figure indicates a substantial market expectation of earnings resilience over the coming year, and also hints or create a lot of questions about possible recessions during this year or the next year. As we dissect this further, it's crucial to understand the variations across different sectors which may impact our investment strategy. Number one, technology sector. These sectors often leads to with higher PE ratios due to expected growth and innovation. Currently, the sector shows robust future earnings potential, particularly in sub-industries like semiconductors and software, which have been pivotal during the ongoing digital transformation across global industries. Number two, the healthcare sector. Despite facing some pressures, the healthcare sector forward earnings look promising. This is because we have a lot of innovations in biotechnology and pharmaceuticals. This sector's resilience is often linked to essential services and products that remain in demand, regardless of the economic fluctuations or downturns. Number three, the energy sector. The energy sector presents a mixed outlook. While traditional energy companies might see volatility, fluctuations, there's growing investor optimism around renewable energy companies and the shift towards sustainable energy sources that gain momentum globally. Number four, consumer discretionary and staples. These sectors reflect more cautious optimism. Consumer discretionary may benefit from economic recovery phases, whereas staples typically offer stability. Obviously, this is less sensitive to economic changes due to the ongoing demand for essential goods. Number five, the financial and industrials. Both sectors are seen as barometers of economic health. Financials have been benefiting from rising interest rates, improving margins. Meanwhile, industrials are getting a boost from increased infrastructure spending and global trade. By analyzing these sector-specific trends, investors can better align their portfolios with areas that potentially offer higher returns based on the forward estimates, understanding where the opportunities and risks lie. Let's talk about something crucial in the financial world, especially when planning for the future. Pre-announcements and earnings guidance. For quarter 2 of 2024, we've seen a dynamic play of forecasts with 35 negative earnings per shares pre-announcements versus only 21 positive ones among the Standard & Poor's 500 companies. This results in an N to P ratio of 1.7. Now, you might be wondering, what does that mean for investors and the market? The N to P ratio, or negative to positive ratio, serves as a barometer for investor sentiment and potential market trends. An N to P ratio greater than 1 indicates that companies are cautious about their upcoming performance than those who are optimistic. This could signal tightening conditions or challenges ahead, affecting investment strategies and market confidence. Understanding this pre-announcement helps investors to gauge the economic climate and sector-specific issues that could impact their portfolios. However, I must say that this ratio has actually decreased from 2.5 to 1.7, and obviously this has its implications. A surge in negative pronouncements in a sector may suggest a slowing demand or operational hurdles, prompting a more defensive investment stance. This has obviously decreased to 1.7. As we move forward, keeping an eye on these metrics will be essential for navigating the uncertainties. That is the other side of the coin of these remarkable earnings. The Starmine earnings surprise forecast is an star mine, a service provided by London Stock Exchange. And it refines the power of analyst estimates by giving more weight to recent predictions from top-performing analysts. This results in a smart estimate which is more accurate than traditional consensus averages. Now, why should this matter to you? Because smart estimates predicted surprise values that have shown to predict the direction of earnings surprises with a remarkable accuracy of 70%. And this goes even to 78% when significant revenue surprises are also considered. Let's look at what is expected in the coming weeks. We have companies like Constellation Energy, Berkshire Hathaway, poised for positive surprises. On the other hand, companies like Bio-Rad Laboratories and Rockwell Automation are on the watch list for potential negative surprises. This nuanced insight allows investors to gauge potential market movements and adjust their strategies accordingly. So in this table, then I am sharing the actual earnings surprise forecast and release schedule. So we have here the report day, and we have here the businesses that actually are have a positive predicted surprise. Among them, remarkably, we have NRG Energy with 29%, right? And also Take-Two Interactive Software from Communication Services, 13.8%. Recall that this is one of the sectors that are performing. And here on this bottom panel, we have the companies that are actually have a negative predicted surprise forecast, including around the most negatives, this Evergy Industries is from the utility sectors with 9.3, and also we have here in communication services Warner Bros. Discovery Industries with minus 8.9%. Okay, thank you for joining us for this detailed review of the earnings session. I'm starting my YouTube channel, so please subscribe. As we wrap up this presentation, let's summarize the key takeaways and look ahead at what's coming. First, we observe a solid earnings growth of 7.1% across the Standard & Poor's this quarter, reflecting a resilient economy environment despite varying sectoral dynamics. Excluding the volatile energy sector, this growth impressed further, extending to 10.2%. What's clear from this season is the significant role of technology and consumer discretionary sectors, which not only surpassed the expectations but also set tone for robust market confidence. However, it's crucial to note that the challenges still faced by sectors like healthcare, which saw some contraction. Looking ahead, based on the insights from analysts and market trends, we anticipate a continuation of these mixed sector performances with a potential shift towards more sustainable and technologically integrated business models. As we move to the next quarter, keep an eye on sectors that are adapting rapidly to changes in consumer behavior and global economic shifts. The agility of these sectors in leveraging technology and innovation will likely indicate their growth trajectories. Lastly, I encourage everyone to consider the broader economic indicators and sector-specific dynamics. Please see my previous video before making investment decisions. Stay informed, stay engaged, and more importantly, stay critical of data as you align your strategies with these market movements. Thank you once again for tuning in, And don't forget to like, share, subscribe for more insights each week. Until next time, keep analyzing and stay ahead of the curve. If you have questions about today's contents, want to delve deeper into specific data, or need assistance with economics or your investment strategies, do not hesitate to reach out to cam.calderon@gmail.com or connect with us to my YouTube channel. All these links are available in the video description below, so please check them out. Right, remember that investing is a journey and we are here to assist you every step of the way. Please note that the information provided in this video is for educational and informational purposes only. It is not intended as financial advice. Always consult with a professional financial advisor before making any investment decision. Thank you once again for watching, and I look forward to seeing you in our next video. Until then, keep exploring and stay informed.